The US government currently carries a 37 trillion price tag in debt. Think about that for a second. More indebted than any nation in recorded history. Larger than the entire global economy produced in a single year just a couple of decades ago. And here's the uncomfortable truth: most people aren't being told they're not planning to repay it. They don't intend to default, they don't plan austerity, and they won't rely on crushing new taxes. Their chosen path is far subtler, far more surgical. They plan to erase it, not with a single headline-making act, but with systemic, calculated devaluation, an invisible theft of purchasing power from every person holding dollars. The surprising instruments in this operation. Things most people assume sit outside government control: crypto and gold. What we're watching is the US orchestrating the most sophisticated debt reduction strategy ever attempted. They're quietly assembling a parallel financial architecture, hoarding strategic reserves in Bitcoin and gold, then preparing to revalue those holdings dramatically. That revaluation, once implemented, will let them technically clean up a debt mountain that is otherwise mathematically unpayable. But the terrifying flip side is this: when they inflate the value of gold and crypto, the dollar devalues in lockstep. Every dollar in your pocket loses buying power. Bonds you own become shadows of their former value. Savings accounts evaporate in real terms. This is legal, policy-driven expropriation, executed quietly, legally, and with plausibly sensible cover stories. And most people won't spot it until after the damage is done. To understand how this works, you must first grasp a simple truth few appreciate. Government debt does not behave like household debt. If you owe money as a person, you need to generate real value to pay it back. Work more, sell assets, tighten spending. Governments have a tool you don't control over the currency itself. That control lets them redefine what a dollar is worth. They can reprice the assets on their balance sheet, change accounting rules, and make debt disappear without literal repayment. This mechanism, a targeted monetary reset, is not speculative, it is precedent. Take 1933. The US was drowning. World War I and the Great Depression left the federal balance sheet in shambles. Debt to GDP sat near 40% and the economy was contracting. Facing deflation and a collapsing tax base, President Franklin Roosevelt took a dramatic step: he revalued gold. Overnight, the government moved to centralize gold ownership using Executive Order 6102, forcing citizens to surrender gold at the official price of $20.67 per ounce. The government collected that gold, then repriced it in 1934 to $35 per ounce, a 69% uplift in the government's favor. Because the state held the majority of the nation's gold after confiscation, those reserves ballooned in accounting terms. Value was created out of thin air by a single policy maneuver. The debt burden expressed relative to GDP collapsed, not through productivity or taxation, but because the currency and asset values were redefined. Citizens holding dollars absorbed the loss, the government's obligations shrank in real terms. That playbook is not ancient history. It's the template, and elements of it are being set in motion today. The US stands at a debt to GDP ratio of roughly 32%, higher than at any time except the Second World War. Annual interest on that mountain already runs about $1.2 trillion, more than many federal departments. If interest rates remain elevated, that figure shoots up. At sustained rates, near 5% interest costs could climb toward $1.8 trillion annually within a few years. The arithmetic makes clear you cannot reasonably tax cut or grow your way out of that burden when interest grows faster than the economy. Traditional routes are blocked. The alternative is devaluation, but a blunt money printing flash would trigger instant panic. So the state is constructing a more sophisticated narrative and mechanisms. Acquire hard-to-ignore assets today and later reprice them as strategic reserves. Enter Bitcoin. On January 23, 2025, an executive order established a strategic Bitcoin reserve in a form and language designed to sound patriotic, to keep the US competitive in digital assets, and to secure economic leadership. Publicly, the rationale is about innovation and national security. Privately, or at least in the financial mechanics of this strategy, it's about creating a new reserve, class asset the government can revalue once it's been accumulated. The US already holds a substantial stash of seized Bitcoin, around 210,000 coins from criminal cases and exchanges, worth tens of billions at current prices. But that alone won't dent 37 trillion. The policy language and legislation being discussed propose expanding holdings. Ambitions include accumulating up to 1 million Bitcoin over several years. The point isn't to buy on the open market at scale that would spike prices and be costly. The real plan is stealth accumulation via seizures, fines, incentive programs, and indirect sourcing. Gather the coins quietly, then change the accounting rules around them later. Here's how the accounting magic plays out in Bitcoin terms. Suppose the Treasury ends up holding 1,000 Bitcoin acquired at an average cost of $120,000 per coin, at $120 billion outlay. If at a later date, the government announces that for reserve and accounting purposes Bitcoin will be valued at 4,000 per coin, the balance sheet jump is enormous. That same 1,000 coins would be counted as 1 trillion of assets on government ledgers. An $180 billion accounting gain appears virtually overnight from a redefinition of value. Because markets will react to a U.S. Treasury declaration backed by policy and narrative authority, the price appreciation will spill into open markets, reducing the gap between official ledger value and market reality. As Bitcoin soars, the dollar's purchasing power collapses in parallel, the two sides of the same event. Gold is the other half of this two-pronged maneuver. The U.S. already possesses significant gold reserve as 833 tons, which converts to a large number of ounces and, at current market prices, a considerable dollar value. Yet on the books, that hoard is valued at a statutory price far below market, leaving enormous room for revaluation. Reprice the gold to a number that structurally changes the balance sheet, and you create trillions in accounting value without moving a physical ounce. Combine that with a civil narrative, restoring sound money, partial gold backing, national sovereignty, and you can sell the move to constituencies that otherwise oppose naked money printing. The result is the same as Roosevelt's. Debt shrinks in real terms while citizens' dollars lose purchasing power. This script is being written now. That's why you see bipartisan proposals, executive orders, and public rhetoric aligning around strategic reserves, gold-backed ideas, and digital asset legitimacy. It's not pure coincidence. It's policy plumbing being put in place before the policy switch is thrown. And when that switch is finally flipped, however it's packaged, the redistribution is almost entirely one way, from ordinary dollar holders and fixed income creditors to the state and holders of revalued strategic assets. In the next section, I'll walk you through the math the government can legally use, the likely timeline for accumulation and crisis, and the concrete, step-by-step things you should seriously consider doing now if you want to preserve purchasing power through a coordinated, policy-driven monetary reset. Let's walk the numbers and timeline as clearly as possible so you can see the mechanism in practical, real-world terms. The U.S. owes $37 trillion. Interest alone is already $1 trillion, plus annually. If interest rates remain elevated, they bite deeper into the budget every year. No combination of tax hikes or spending cuts at politically feasible levels, and no plausible economic growth scenario closes that gap. So policymakers are building a play where balance sheet engineering, not repayment, resolves the arithmetic. That engineering relies on two components: acquiring strategic reserves now and legally redefining their accounting value later. Bitcoin and gold are the chosen reserve tools because they're politically saleable and, crucially, can be revalued in the public eye as strengthening the nation's financial position rather than as covert devaluation. Concrete example on Bitcoin: suppose over the next 3 years the government quietly accumulates 1,000 ZALs in Bitcoin at an average cost of $130,000 each, an aggregate of $120 billion. If the Treasury later assigns a $100,000 per coin valuation for reserve accounting, that holding transforms into a $1 trillion asset line. That's an $880 billion instantaneous accounting windfall achieved through redefinition, not market trading. Markets will likely follow because the U.S. government's buying power and signaling matter. The official valuation serves as a market anchor. Bitcoin's market price would climb significantly in response as private holders reprice expectations. The dollar's value relative to Bitcoin would plummet. Now the gold angle. The U.S. holds 833 tons, an enormous physical position. At current market prices, that's worth many hundreds of billions, but on the books the statutory valuation is dramatically lower due to legacy accounting rules. That discrepancy creates a massive revaluation opportunity. If the government decides to mark that gold at a much higher number, by way of an official revaluation to, say, a price that makes the math work for debt reduction, the balance sheet changes in a meaningful way. Combine that with a strategic Bitcoin revaluation, and you've created multi-trillion-dollar accounting gains without borrowing, selling assets, or ostensibly increasing taxes. From the government perspective, debt metrics improve. From the citizen perspective, the dollar has been debased. Important nuance: this strategy doesn't instantly make goods and services cheaper because nominal debt falls. It transfers burden via inflation. When gold and Bitcoin are revalued upward, the dollar buys less. That's the core of the theft argument. Your savings and fixed income holdings are repaid in nominal dollars that are worth far less in real purchasing power. Bonds remain nominally intact. You still receive promised dollar payments, but those dollars have much lower real value. Savers and creditors effectively subsidize the debt reduction. So how does the government move from accumulation to revaluation without sparking immediate panic? The answer is narrative and timing. Policy steps can be framed as national security, sound money, or competitive necessity. A strategic Bitcoin reserve gets framed as ensuring technological leadership and protecting innovation. Gold back and partial gold backing talk is marketed to conservatives as restoring fiscal responsibility. These stories make revaluation politically palatable. It can be sold as strengthening the dollar, not destroying it. Meanwhile, accumulation takes place quietly through seizures, fines, purchases by intermediaries, or mining initiatives that don't shock open markets. The market doesn't fully price the government's holdings until the public announcement. When that announcement arrives, the government claims it acted responsibly and that the move secures American financial leadership. Many voters buy it because gold-backed and strategic reserves sound sensible compared to the political alternatives, default or harsh austerity. Let me give you the likely timeline to make this less abstract. The 2025 accumulation phase. The U.S. quietly acquires additional Bitcoin via seizures, fines, strategic purchases, and perhaps state-involved mining. Gold remains on the radar as policymakers publicly discuss partial backing, and the language of sound money becomes more mainstream in Washington's policy circles. The narrative groundwork is laid. The 2026 crisis phase. Debt ceiling fights, bond market stress, or fiscal showdowns create a plausible crisis scapegoat. Elevated interest rates and market anxiety provide the political moment where extraordinary measures become palatable. Crisis normalizes extraordinary policy. The 2027 revaluation phase. The government announces the strategic Bitcoin reserve and assigns an official accounting value far above current market prices. Simultaneously, they introduce partial gold backing and revalue the gold reserve for accounting purposes. This dual action is publicized as a stability measure. Markets reprice accordingly. Bitcoin and gold spike. The dollar's purchasing power collapses in parallel. The 2020-2030 stabilization phase. Markets settle at new asset price levels, inflation normalizes at a higher level, and debt metrics look much better on the government's books. The new monetary reality becomes the baseline. Under that scenario, the accounting gain from revaluation does not pay off debt directly. It offsets it on paper and alters debt ratios. But the political outcome is the same. The government avoids default, and the real weight of debt falls dramatically. The fiscal pain is shifted off the state and onto savers, bondholders, and anyone holding cash. Who wins in this scenario? The winners are structural, the government, because it survives without default, politicians, because they avoid politically painful choices, early holders of Bitcoin and gold, if they own before revaluation, foreign states that have been stockpiling gold and digital assets. They gain on a revaluation too. Corporations and asset holders with inflation, protected positions, or whose incomes rise with nominal prices also fare better. Who loses? Everyday people with savings, retirees on fixed incomes, pension funds loaded with government bonds, and anyone whose wealth is in nominal dollar terms. Pensions are particularly vulnerable because they rely on long-duration government bonds and fixed nominal streams. Wages typically lag inflation, so real incomes fall. Small businesses, consumers on fixed incomes, and mortgage-reliant households without fixed low-rate loans are squeezed. The middle class bears the brunt. This is not hypothetical when you look at history. Hyperinflationary and debt-erasing episodes in Weimar Germany, Argentina, Zimbabwe, and Venezuela all share the same structural pattern. Governments faced unsustainable obligations and chose to devalue the currency or allow inflation to spike rather than impose the political pain of default or deep spending cuts. The nominal debt stayed on the books, but its real burden collapsed. That political calculus, preserve state power, shift pain onto the populace, is not unique to those states. It's a perennial option for any sovereign that controls its currency. Let me be blunt, this process is legal and will be framed as responsibility. Revaluation and reserve strategies will be presented as prudent stewardship, not theft, and that framing matters. When policy is retrofitted with plausible, widely palatable rationales, popular resistance is muted. By the time the real purchasing power effects ripple through grocery prices, energy bills, and mortgage rates, it will feel like economic weather rather than policy malfeasance. But the outcome is the same. Real wealth has been redistributed. If you're still skeptical, ask yourself who's been buying gold and accumulating non-dollar assets recently: central banks, sovereign funds, and geopolitical rivals. When state actors with deep policy intelligence scoop up hard assets, they're making a bet on the future of currencies. They are preparing for scenarios where dollar dominance erodes. And they're not the only ones. That's why we see the gold and crypto conversation move from fringe forums into government halls. The policy scaffolding is being built in plain sight. Next, I'll give you a specific, pragmatic checklist of protective moves to consider if you want to preserve purchasing power through a coordinated, policy-driven reset. These aren't slogans. They're tangible, actionable steps derived from the mechanics you've just seen. You've seen the mechanics and the likely timeline. Now let's move to actionable steps. Precise, prioritize moves you can implement immediately to protect purchasing power and reduce exposure to a policy-driven devaluation. I'll be concrete and practical. This is not financial advice. It's a set of risk management actions based on the scenario we've mapped. Decide what fits your situation and risk tolerance and act deliberately. Reduce exposure to dollar-denominated bonds. Long-term government bonds and even many corporate bonds will be vulnerable if the dollar is devalued. Nominal payments won't change, but real value will. Consider trimming or exiting long-duration bonds. Short-term, high-quality paper or cash equivalents preserved for operational needs are safer than long-duration instruments that take years to roll. Evaluate pension and retirement allocations. If a large share is in long-term treasuries, that's concentrated dollar creditor risk. Limit cash holdings. Cash and bank deposits are the most direct victims of purchasing power loss. Keep an operational buffer, enough to cover 3 months of expenses. But don't sit on large cash positions long term. Excess cash should be moved into assets that historically preserve real value. Acquire hard assets, physical gold and select commodities. Physical gold remains a proven long-term store of value. If you buy, prefer tangible bullions, coins, bars stored securely under your control or using trusted vault services. Aim for a meaningful but sensible allocation, targeting something like 10 to 20% of net worth in physical precious metals for many risk profiles makes sense if you're convinced about a potential reset. Complement gold with commodity exposure. Energy, agricultural land, and industrial metals often protect against real price shocks and inflationary episodes. Consider Bitcoin selectively. Bitcoin is volatile but plays a different role, a potential asymmetric upside asset if revaluation occurs. If you understand custody and security, a modest allocation 5-15% depending on risk tolerance to Bitcoin can hedge extreme currency scenarios. Security is paramount. Use hardware wallets, multi-signature custody, and establish cold storage practices if you go this route. Reassess mortgage and consumer debt. Pay down high-cost consumer debt immediately. For mortgages, fixed low-rate mortgages are complex. In a devaluation scenario, fixed-rate debt can erode in real terms. That's beneficial. But housing market shocks and liquidity stress can offset that. If you have an adjustable rate or high-rate mortgage, prioritize reduction or refinancing into a fixed, low-rate structure where possible. Don't take on new speculative real estate debt unless it produces real cash flow. Diversify across currencies and jurisdictions. Having some assets, accounts, or investments outside the US dollar provides resilience if the dollar collapses relative to other currencies or asset classes. Look at strong, low-debt jurisdictions, conservative banking systems, and diversified international stocks. Foreign real estate may also be a hedge if it's producing income in non-dollar currencies. Shift some equity exposure to inflation-resilient sectors. Companies with pricing power, utilities, consumer staples, energy firms, and commodity producers can pass inflation onto consumers and preserve real margins. Real assets that produce cash flows tied to inflation, like certain lease structures, can offer protection. Consider commodity-focused funds for inflation hedges if direct ownership is impractical. Build practical skills and local resilience. When currencies implode, what matters most is what you can do and who you know. Practical skills, trades, agricultural competence, medical or logistical capabilities become high value. Community networks that can share resources and skills matter more than paper wealth in severe disruptions. Hold a contingency plan for liquidity. The first waves of a reset cause volatility. Keep a small, accessible pool of liquidity in assorted forms, short-term foreign currency accounts, stable digital assets, or operational cash to exploit dislocations or meet urgent needs without being forced to sell valuable real assets at fire sale prices. Review pension exposure and retirement strategies. If you rely heavily on defined benefit pensions invested in government bonds, understand that real payouts can be devastated by a devaluation. Consider diversifying retirement portfolios toward real assets and equities with global revenue exposures. Guard against scams and misinformation. In crisis, opportunists proliferate. Be skeptical of anyone promising guaranteed returns or insider fixes. Validate custodianship. Insist on physical possession for precious metals if you choose that route, and use reputable, well-known platforms for any crypto activity. Know the difference between sound hedging and speculative gambling. Mental preparation and contingency mapping. Financial shocks are also psychological shocks. Have a household contingency plan where you reduce expenses, how you access essential goods, who you can rely on locally, and how you maintain income if nominal wages get squeezed. Preparedness reduces panic-driven mistakes. Timing is crucial. If the accumulation phase is indeed underway in 2025, the window to reposition is now. The crisis justification, whether political brinkmanship, a bond market panic, or a fiscal showdown, will be used to push the revaluation stage forward. If you're already positioned in hard assets and diversified internationally, you'll have preserved purchasing power as these policies land. If not, the revaluation will feel like a sudden storm that arrived too fast. Now let's be candid about the broader societal effects. A reset driven by asset revaluation is redistributional by design. Governments get breathing room, creditors lose, savers are penalized. The social consequences are severe. Inflation squeezes real incomes, pension systems strain or collapse. Small businesses face higher input costs, and the middle class shrinks. Political instability and social unrest are common outcomes in such transitions. That's why you see geopolitical actors accumulating gold and alternative financial infrastructure. They're hedging systemic risk that can transcend any single economy. At the moral center of this argument is an uncomfortable truth. Policy choices about debt and currency are choices about whose wealth is preserved and whose is sacrificed. The mechanisms can be legal and marketed as responsibility. The result can still be theft in real economic terms. Recognizing that reality doesn't make you cynical. It makes you pragmatic. Knowing the mechanics allows you to act and to protect those you're responsible for. Finally, if you're serious about taking action, map out a phased plan and execute it methodically. Don't panic buy without a custody and security plan. Don't sell everything you own and go all in on one asset class. Balance conviction with prudence, diversify across gold, select Bitcoin exposure, income-producing real assets, international holdings, and a thoughtful debt reduction strategy. Build redundancy in custody, legal advice, and international exposure. This is a long game. Policy moves will play out over years, not days. But the signals are visible now: executive orders, legislative proposals for strategic reserves, public rhetoric about gold-backed concepts, and central bank asset shifts globally. Whether you interpret these as benign reform or the scaffolding of an intentional debt revaluation, the prudent response, if you believe the mechanics I've described, is to reduce exposure to plain dollar credit, increase exposure to historically reliable stores of value, diversify internationally, and keep more of your portfolio in things that represent real, enduring purchasing power. You can be outraged at the injustice and still prepare. That's not surrender, it's survival. Preserve capital, preserve options, and be ready to rebuild while others are still trying to digest the shock. The reset I've described is policy, driven and legal. It will be sold as necessary stewardship. The historical pattern is clear: sovereigns with unsustainable debt often choose inflationary strategies to survive. The only question left is which side of that redistribution you will be on when the dust settles. If this reframing changed how you see things, don't keep it to yourself. Share this with anyone who has savings, a retirement account, or trust in nominal dollar security. Their future purchasing power could depend on the choices they make today.